Today I'm in conversation with Dirk Jooste, who is fund manager on two of PSG Asset Management multi-asset portfolios, the PSG Stable Fund and the award-winning PSG Balanced Fund. So both of these funds have access to the full multi-asset toolkit and both are Regulation 28 compliant. But there are differences in terms of the fund objectives and the investor journey that they are trying to deliver. So the higher risk PSG Balanced Fund has an objective of CPI plus 5%, while the moderate risk PSG Stable Fund has an objective of CPI plus 3% over rolling 3-year periods. Now, Dirk, I think that many people would assume that the big difference between these funds is in the equity and bond allocation, and that's where it stops. But it's not the case. So can you give us an idea on how the differing objectives and investment journeys that these funds are trying to deliver lead to differences in terms of how you manage those portfolios?
Yes, Audrey. So broadly speaking, the amounts of equities relative to the fixed income or the mix between the two would dictate the risk versus reward profile of these mandates. But at PSG, we have a process that does go quite granular down to the security level, where we carefully assess the attributes of every single security that's included in our portfolios. So broadly speaking, yes, the lower risk mandates will have lower exposure to equities, but within the broader asset classes, we do also do an additional layer of curation within the asset classes to make sure that we control further for the journey within the different kinds of funds.
Now, in addition to the differing allocation to equities, for example, in the PSG Stable Fund, you can also look at things like the different risk profiles of the specific shares in the portfolio and the correlation between those shares in order to deliver a different investment experience and journey. So can you give us an idea how you factor that into portfolio construction in these two funds?
Sure. I think a couple of years ago we set ourselves an objective to make sure that the buy list that every fund can shop from is sufficiently diverse that it can cater for the needs of all the mandates. I think if you look at our equity buy list, the general acceptance is that it's not only created to cater for equity funds, but we've designed it to be sufficiently colorful that it can cater for the needs for the various kind of risk mandates. Our investors are well aware that we have a 3M process, so that typically does look at the quality of the securities that we consider. Most notably, we would consider the management or the custodians of a business, also the competitive positioning of that company, and then how that relates to the price. Over the years, we've also paid very careful consideration what we would call the range of outcomes for every single security that we consider. And this is just a pragmatic view and us trying to get a sense for the range within a shorter time frame for the securities that we include. And this has been very helpful. So if you look at the lower risk mandates, this enables us to be a little bit more circumspect for the securities that have the ability to have a larger range of outcomes over shorter time periods. So this gives you a sense in terms of the curation within an asset class like equities that we will apply a slightly different lens when we do look at the lower risk mandates. Similar to this, we also pay very careful consideration into correlations, and we will consider across the different asset classes as well, and we'll apply a slightly different curation as well for the low risk mandates, taking careful consideration of potential layering of bets that could have an influence on the shorter term journey.
So you also have access to derivatives to add to how you manage these portfolios. Can you give us an idea of when and how they are used?
Yes, so clients will notice over the last few years we have made use of derivatives. We find ourselves in quite a unique environment. We have a view that coming out of the COVID period, that there's been quite a stark change in terms of the global market dynamics, and we have probably reached quite an important inflection point. what we see going forward is a higher likelihood of macro volatility being elevated. And this is most notably through the channel of inflation and interest rates. Now, pre-COVID, we've lived through an era of very low macro volatility, low inflation, and low interest rates. And coming out of COVID, we do think that there's been a stark reorganization of the global interdynamics. And we probably will see much higher inflation and interest rate volatility going forward, or what's more appreciated relative to what the market is implying. So this does mean that we actually do see the use of puts being quite attractive, because their pricing actually implies that the dynamic is still more of the same as we've seen prior to COVID. And as well, if we look at the indices, the composition of the indices are also still reflecting an environment that probably benefits more deflationary type of assets, and we're quite concerned in terms of the aggregate valuation of indices. At the same time, our bottom-up process is suggesting it's a very fertile opportunity set that we see in front of us. So we have a bit of a conflicting signal. We're quite macro-aware and quite concerned of the macro picture. And at the same time, we have a very good fertile opportunity set. So we've chosen to remain true to our bottom-up signals and take advantage of those opportunities. And we think the use of puts or derivatives within our process is quite an elegant way just to control for the risk and reward dynamic. And that's how we've chosen to navigate the current environment.
So given the different objectives of these funds, do you see or view the role of the fixed income component differently?
Yeah, so similar to equities, when you look at different risk mandates, you will apply a different curation to the equities you would include into your portfolios. Most of the times it's not exclusionary, it's just the weight that you apply to a certain security within the portfolio. Very similar to our fixed income buy lists. Again, the fixed income buy list we've designed to speak to different arrays or a whole variety of risk mandates, so that it caters to all the needs of our funds. But typically what you would find as you go down the risk spectrum, you would favor fixed income instruments that will have the ability to more rapidly adjust to changes in an environment over the short term. This might be changes in the inflationary environment or interest rate environment, or even a different outlook on sovereign risk, as we've recently experienced in South Africa. So this means as you go down the risk spectrum, you would probably find a more elevated use of money market instruments, instruments like floating rate notes that can rapidly respond to changes in the repo rate, or inflation-linked bonds that can also adjust to short-term changes in the inflation environment. As you go up the risk spectrum, as an example for the Balanced Fund, you would see more a notable use of fixed rate instruments like South African government bonds, and the appetite to take a little bit more advantage of duration in the bond market as well. So there is a different curation that we apply within the fixed income space as well.
So Dirk, PSG Asset Management follows a globally integrated investment process. And part of that is that you use the returns available on local cash as a kind of a benchmark when looking or assessing the returns that you should be getting from other asset classes. So again, looking at the differing objectives of these funds, can you give us an idea of how that pans out in terms of fund construction?
Yes, so we have quite a granular process where for every single security that we consider, we will define a minimum required hurdle rate and try and relate that back to the prevailing price of that security. Typically when we're in a universe where not a lot of securities meet those hurdles, you will find those kind of buy lists being sparsely populated. Currently, we're quite spoiled for choice. Our global equity buy lists are quite full, same for our local equity buy lists. And we're also finding quite a lot of attractive opportunities in the local fixed income space. So this bottom-up signals and what we're getting from our different buy lists typically would dictate to a large degree how the asset allocation within the multi-asset funds manifest, if you can call it like that. An interesting example, what we're seeing today is in the local credit market, we aren't finding a lot of good opportunities. We think the market has been finding credit attractive from a volatility suppression point of view. But if you consider the liquidity or the illiquidity of these instruments and the level of credit spreads at the moment, we aren't finding them attractive. So that's quite interesting from a bottom-up perspective. You will see our credit buy lists aren't populated to a large degree, and that will reflect on our asset allocation as well. But as I've mentioned, we're seeing a lot of opportunities in global local equities and the local fixed income markets. And within our multi-asset funds, we will be quite careful, again, of this concept of layering, of having correlated bets. And in the lower risk funds, what you will find, as an example, our local equity buy list does have a good allocation to South African banks, but they are quite correlated to South African bonds within our fixed income buy list. So we will take a bit more of a circumspect view in the low risk funds of having both of those. And what you would typically find is quite a lower allocation to South African banks on the equity side, given that the funds are also taking advantage of government bonds on the fixed income side. And as you go up the equity or the risk spectrum, you will find quite a different use where there's a bit more of a larger allocation to South African equities on the banking side.
Dirk, thank you so much for taking the time to chat to us today and explain PSG Asset Management's multi-asset fund management process.
It's been a pleasure. Thanks, Audrey.
Thanks.